Yeah, let's actually show a chart of the yield curve inversion. This is a 10-year treasury minus a 2-year treasury. It inverted very briefly a few months ago. Since then, it has exited inversion. Harley, how much of a harbinger for a recession do you think this is?
Okay, so I publish every 4 to 6 weeks because I only publish when I have something to say that I think is interesting and meaningful. People who are paid to publish once a week or even once a day, which I find utterly insane. Nothing happens every day that's newsworthy. I can assure you of that. But that's your job, man. You got to go and put something out. This is the kind of chart that people put out who have to publish something once a day. This is not the right chart. The actual rule is the 3 month treasury versus the 10-year treasury. Now, people like me will go and put up charts like twos, tens, or maybe swap rates, or maybe forward rates, which are interesting and by themselves. But we actually have not inverted to the real rule, which is a 3 month treasury versus the 10-year treasury. As a matter of fact, that spread has actually widened, gotten bigger. In forward space, we've inverted. We've crazy inverted. So this is a little tricky here. And so we got to wait and see how far the Fed actually goes and pushes things, or how far the back end comes down. I recall now your question from before, which is about the volatility of the yield curve and why it went so crazy a couple of months ago. We had twos exploding higher in rate, lower in price, whereas bonds were actually rallying. So you'd see, usually what you see is twos up by 10 basis points, bonds up by 5. So they both go up, but twos by more, so the curve flattens, or vice versa. What you saw for a month a while ago was twos up by 15 and bonds down by 5. This is very, very rare. It's a curve rotation where the actual sign is different. This is, I won't say impossible to hedge, but there's body bags being carried away when this happens. It's very hard to manage this as a dealer, or as anybody for that matter. The reason why this happened, I will propose to you, is that there were, X billion of structured notes issued 3, 4, 5 years ago as a way to go and get added yield to retail clients. And I've bought these things for my own personal account. I'm not going to say anything bad about them. They look like this. You get a 7% yield for a year. After that, you get 5 times the spread between the 2-year and the 30-year. So if 2's 30s is at 2%, then you get a 10% coupon. If they're at 1%, you get a 5% coupon. If they go negative, the dealer will not take the money from your account. They're principal protected, principal guaranteed. You can't take the money back. The dealer, unfortunately, is hedged, and he doesn't have that option, that goodie. He's not getting the money back from people. He has to go take off the hedge. He takes it off by selling twos and buying 30s. And so if you go look at the shape of the yield curve in forward space, which is where this, because these guys are hedging out the next 5 years, when that thing went through zero, all hell broke loose in the market. And that's what really drove this massive power flattening and inversion in forward space, is dealers taking off the billions of dollars of hedges they had on because they were short a zero strike option to mom and pop. Once we have gotten through it, and we're now through it in forward space by a lot, things will stabilize. That's why you've seen, the market, the curve stabilize. If we ever get the curve to start to steepen again, and those forward rates start to get near zero, you're going to see a massive power steepening as dealers put the hedge back on again. The curve will get extraordinarily volatile if we ever get that 2's 30s curve back towards zero in forward space. So that was your first question. That's why it happened. Is the curve predicting a recession? Curve's almost always right, and because the money goes there for various reasons. Are we going to get a recession, next year? I don't know. I mean, the curve per se, the classic curve of 3-month versus 10-year is not even close. But in 3 months or 6 months, we're going to get there. The Fed's going to take rates up. In 3-month rate, it's going to be, $1.50 higher. Well, then it'll be interesting. So we're not there yet. And indeed, the curve inverted in November 18, and I wrote a story back then, a commentary back then, where I said, everything looks great. I have no idea how it's going to happen, but we're going to go into a recession in March, April of 2020 because we had the signal, and you got to stick with the program. It's never different this time. So did I predict COVID? No, but it did happen.
Okay, so right now you're not seeing the same flash of recession signal as you were in 2018.
No, but I mean, away from that, you can't argue what the curve's doing. I mean, you have 5s, 10s inverting in treasuries, and certainly 2s, 30s is pretty close. I mean, the fact that it hasn't actually inverted, forget that. I mean, we have an 8 inflation print, and the back end's rallying. I mean, the market is cueing that if not recession, we're talking massive slowdown in the economy. Okay, I mean, let's not bury the lead here. I mean, the curve is flattened dramatically, and that means something.
Yes, but again, Harley, you just play devil's advocate. 32% drawdown on TLT. Your product doing very well. Worst start to the year for the 10-year Treasury note index since George Washington. There's been so much. How much more pain can we have in the long end? The fact it's a relative. So the fact of the matter is the short end has gone up so much. If you look at the move index, that because the Federal Reserve is so far behind the curve. So how could it be any other way?
You can get a lot more pain, man. I mean, rates at the 2 handle with inflation at 8, you have a lot more pain. Okay, it's only painful because we started at 1.5%. That's why. I mean, but by the way, 3 is still a crazy low number over the history of time. We just, I mean, it's kind of like you look at SPOOs right now at 410 or 415. That's only down 20% because we were at 4,800. We could argue that 4,800 was the wrong number, and now we're closer to the right number. I mean, when you see a change in something, it's unclear which is the wrong number. I mean, Netflix is down 70%. That's probably because the $700 price was the wrong number, not because today's $190 is the wrong number.
Harley, now let's move on to mortgages. Mortgage rates were so low for so long over the past 2 years. To what degree was that because of quantitative easing? And they've had a historic spike over the past 6 months. To what do you attribute that? And then we'll explain why you're starting to get sort of, I guess, cautiously bullish on mortgage-backed securities.
Okay, so I'm not cautiously bullish. I'm very bullish on mortgage-backed securities.
All right.
So the low mortgage rates was a feature, not a bug. The Fed's driving of that was 105%. Correlation to them. Okay, let's not fool around, man. That's not that chart. That one. I mean, the Fed drove mortgage rates down. They drove mortgage-backed securities to as low as 20 basis points over treasuries. This is insanity. The forever average is 75. This is just nuts. And they did that. And they did that because they wanted to go and help people buy housing. That's a public policy good. It's well known that home ownership is well correlated with economic and social success. Let's not go into why that is, but it's just a well-known fact. And so that they did a good deed. They also drove the market to the wrong price. You could see where they announced they were going to stop buying, and kaboom, off we went. We got as high as 115. It's now 105 as a spread. Once again, that's the wrong number, okay? I mean, it's the wrong number. And now it can be the wrong number for a while, but that's the wrong number. And it's going to tighten back in again because if you're a pension fund or an insurance company and you could buy a effectively government bond at 100 over treasuries, 100 over treasuries, ding dong, wrong price, right? Yes, you have convexity risk, and I detail that in my latest commentary. But I mean, really? Why are you going to buy a bond that might default when you could buy something that won't default no matter what?
Yeah, Harley, I just want to make that clear that some people, they might have seen The Big Short, somewhat familiar with the 2008 financial crisis, and they think of that when they hear mortgage-backed securities. But the mortgage-backed securities that melted down there was credit risk. There were private mortgage-backed securities that were packaged into extremely toxic and labyrinthine structures. This is just pretty vanilla mortgages that are guaranteed. They have no credit risk. They're guaranteed by Fannie Mae, right? So your risk here is interest rate risk, not credit risk. Do I have that right?
Exactly. Yes. Fannie Mae, your risk in mortgages is convexity risk.
Okay.
Fannie, if it says Fannie, Freddie, or Ginnie, it will not default. Period. It won't default. Now, and you will get your principal and interest on a timely basis. The servicer, people behind Fannie and Freddie, they got to go deal with the nonsense of foreclosures and everything else. But you will get your money every 30 days on time, rain or shine, no matter what. Now, you might get all your money back in 3 months. You might get it back in 30 years. That you don't know. That's the convexity issue. But you're getting your money back, man. Don't worry about that. If Fannie and Freddie default, you better own guns and cans of tuna because it's the end of the world.
Explain why I might expect to get my money in 3 years, but I actually get it back in 30 years. What would have to happen for that to happen, and why is that a risk?
This is why we hired, a football stadium of physics PhDs, 20 years ago, to go and figure out what would make a mortgage prepay. Let's go look at a single person. He takes out one loan, takes it out at 4%. He has the right to prepay that loan whenever he wants, no penalty. Now, most other countries, except for Denmark, don't have fixed rate loans for 30 years that you can prepay. If you were, I'll give you a multifamily loan or a commercial loan, there's a prepay penalty for those. In home mortgages, there are not, because the U.S. government did not want people to go and have to pay a penalty to refinance. You have a 4% loan. Rates go to 3%, and that loan flows on through to a buyer and buys the 4% loan. We ignore all the costs in between. So homeowner takes out a 4% loan, and IBM pension buys the 4% loan. Rates go to 3%. The homeowner calls up the broker, refinances, pays off his 4%, and takes out a 3% loan to lower his mortgage costs. IBM has that loan called from them. They get their money back all early, and now they got cash. And what are they going to do? Well, they got to now buy 3% bonds, right? They're not going to sit in cash. And so they basically thought they had money locked up for a decade at 4%. Turns out they only had it for a year. Now they got 9 years at 3%. They're sad. But they got an extra yield for that, taking that risk. If rates go to 5%, whoever says, I got a 4% loan, I can't believe I did this. He's not prepaying that loan. As a matter of fact, if rates went to 8%, he might not be able to move ever because he's locked in that 4% loan. And if he moved to a new house, he has to pay 8% to go and do it. So he's kind of stuck there now. Gini Mays are assumable, but ignore that small detail. That loan's staying on the books for a long time. Now, IBM, when they bought the 4% bond, they did their bond math and said, you know what? I think this bond's going to pay off almost all of its money over 7 years. Okay, I'll line everything up and I'll get that and I'll reinvest the money, in 7 years. Well, now it's like a 20-year security and they're getting a 4% yield for 20 years, and they could have invested the money at 8% if they got the money back earlier. So they lose both ways, okay? Homeowner wins both ways. The question is, what is that option to prepay worth? So what will IBM demand in extra yield over treasuries to take that uncertainty, that path dependency risk? Now, there's more than just rates. If the economy is doing great, employment's down at 2.5% unemployment, and people are getting calls for jobs everywhere, and I'm sitting in California, and I got a call from a guy saying, I will double your salary to move to Austin to go and code for me. Okay, house sold. Moving to Austin, man. When you sell the house, what happens? The loan gets paid off. Grandma's in the house. Granny dies. Okay, house gets paid off. Husband and wife are in the house. They get divorced. House gets sold to go pay the divorce settlement. That gets paid off. Guy loses his job. Gets foreclosed upon. House foreclosed. Loan's paid off. All these things drive it. The yield curve gets very steep. People will go from a fixed rate to an ARM to go pay off the front end. all these things drive, and they intermingle with each other. Okay, so and that's what these geeks do. They sit in the back room, they try and figure out how all these things will fit together, and then we then say, okay, what is the value of the option? And we look at a mortgage security and say, how much over treasuries am I getting? It's worth, let's say, 50 cents, 50 basis points, and I'm getting 75. Oh, well, it's a pretty good deal. It's worth 50, I'm getting 25. I don't want those things anymore. That's kind of how the game is played over here and where the quants fit in. And then OAS, option adjusted spread, is where we go and take the theoretical model, pull that out of the mortgage security and see what's left. If I'm getting a lot more, that's a positive OAS. I'm getting a spread over the option value. If it's under negative OAS, I'm getting paid less. And the charts I've been showing you here basically are mapping out these various numbers and trying to say, here's the average we have over time. If it's way above or way below, I want to buy or sell. Right now, with the mortgage spread at 510 over, that's 2 standard deviations. And if you look at that chart again, we only got there twice before, man. Once in 08, 09, and once during COVID. I mean, we're not going to stay here. So the mortgage is going to tighten back on in.
So there's prepayment risk where people get the call to go to Austin, they cancel the mortgage, they pay it back, or mortgage rates decline and they can refinance, they also pay it back. There's also extension risk, which is mortgage rates increase a ton as they have over the past 6 months, and therefore no one refinances. So the refinance that was priced in is actually wrong. So therefore the mortgage-backed security you thought was 3 years is actually 10 years. Which is a greater risk? Which I mean, I guess it's different for different parties, but what are investors more worried about? Extension risk or prepayment risk?
Investors in general, prepayment risk, because they thought they had a 4 or 5% security, and now they got to reinvest the money at a low rate. And now they reinvest the money at 3, then rates go back up again. Well, now it's like, holy cow, man, I had 4, I sold it. Well, I didn't want to, but I got prepaid. I invested at 3, and now rates are at 5, and my bond's trading at 8, and is down 15%. That is a bigger problem. Extension risk, we don't like it, but when we bought the bond at 4, we were happy at 4. We liked it 4. If it's 15 years versus 7 years, I'm not brokenhearted, but I knew what I was getting into when I bought the bond. Okay, I mean, a mortgage security is not a 1 year or 2 year treasury. Okay, so you kind of knew you were getting into an intermediate term duration security. So prepay risk is, from the investor standpoint, is a vastly bigger problem.